Okay. Hi. I think nearly everybody is now shuffled into their places, so are we all sitting comfortably? I'm Simon Lambert. I'm the editor of This Is Money, the financial website and the money section of the Mail Online. The first thing I wanted to do is just to welcome you all here today to the Stock Market Show on behalf of This Is Money. We're the media partner for the show, and when our friends at the London Stock Exchange and Shares magazine approached us and said, did we want to get involved, we were delighted to, because it's really good to have an investing event that's all about financial education, that's got some really good informative seminars, some great people to speak to out there. And I think it's a really good idea, and I hope you've all had a good day so far and continue to have a really good day. I think that last presentation was excellent and exactly the kind of thing that this is about. So my presentation is about what to do with investing ideas and tips. So without any more stalling, I shall move on. Now, when I was thinking about how to open this, I did a trawl around all the great investors, trying to think who had some words of wisdom that could sum up what to do with investing ideas and tips. And that's a pretty easy thing to do nowadays. The internet means that there's loads of great blogs out there. It's easier than ever to get your hands on some fantastic investing books. Things like, authors like Ben Graham and people like that. But actually, it was this chap that I came to. That is Chuck D of Public Enemy. And as far as I know, he's not a renowned investor, privately or publicly. But what he did say was, don't believe the hype. Now, if there was one thing that I would hope that you took away from this talk today, it would be just to bear that in mind. Whenever you hear a great idea or a great tip that you think, this is brilliant, I'm going to make a load of money on this, don't believe the hype. Question it. Don't get overexcited. Don't pile in. Keep your head. So, should you just ignore tips? Well, there'll be some people who tell you should, but I don't think so. I think that tips can actually be very useful. They're a really good starting point for your own investing ideas. Most people just do not have the time or the resources at their hands that a professional investor does, that an analyst does, that even a journalist does. And what tips and investing ideas do for you, the best ones at least, is they start the research. They lay out the investing case. You can read that and you can think, well, am I interested? Does this sound good? Is this a company I've never heard about before? Is this a new aspect about a company that I hear about all the time, but I've never thought, well, oh, yeah, they do that. Maybe that's interesting. So I think tips are great. I think investing ideas are great as well. But ultimately, it's up to you to elaborate on them, to dig down and to do your own research. And I couldn't underline that last bit more than anything else. Do your own research. It's your money that you're going to be putting into these companies or funds, and so you have to take responsibility for that. Someone might tell you about an idea, but you need to check it out. Don't pile in. Don't just gamble on luck. You could follow tips and do very, very well, because they might go up, they might go down. It's a 50% chance. But, do your research. So where do tips come from? I think this is something that's really important to consider before you think about what you're going to do with a good idea. Is where is this coming from? I imagine that those of you here will read plenty about investing, plenty about shares, plenty about funds. There's great ideas out there about shares, investment trusts, funds, ETFs. Some of them are big names. Some of them are small companies you've never heard about. Some of them are some really esoteric ideas. But they're all going to come to you through some form of medium. So I've just categorized the main ones here. You've got the mainstream media, newspapers, magazines, websites like This Is Money. Now, what I don't want anybody to get the impression is that I'm snobbishly suggesting in some way that anything coming out of the mainstream media is in any way better than something from somewhere else, because, it isn't necessarily. But what you have to bear in mind is that the tips that you'll read in there, say you're reading Midas in the Mail on Sunday or on This Is Money, if you're reading Questor in the Telegraph, Tempest in the Times, You're reading the Investors Chronicle, the excellent Shares magazine as well. There's a profile, and there's a reputation, and there's a scrutiny placed on those mainstream media publications. And there are checks and balances before any of that stuff is published, to a degree that you can pretty much rely on, especially if it's a respected publication. So you can look at that and you can think, okay, well, you know, I know that somebody's going to have been through that. It's not just anybody who's published that. And then you have the non-mainstream media. Now, I'd say this is probably the fastest growing source out there. Blogs, independent websites, newsletters. And these are great. I mean, the amount of investing content being put out there in this format at the moment of a really high standard is fantastic. A lot of it is just being done because investors want to share ideas. A lot of it's being done to make money, and a lot of it falls somewhere in the middle of that. But you do need to bear in mind that it doesn't cost anything to set up a website. It doesn't really cost much to set up a newsletter or a blog. So how much do you trust this person? What sort of track record have they got? Read through the rest of the things that they've written. Have a look around. How are they interacting with other people? I'm always really loath to use the word community for fear of ending up in Private Eye, which has an actual dedicated section to people who use the word community up for things. But there is an investing community out there. These blogs, independent websites, newsletters, they're part of that. So, you know, just do your due diligence on that as well. Also, there's other investors. Now, in the old days, this would have been word of mouth. This would have been, you know, your friend at work, the bloke down the pub, your father-in-law, your brother, your aunt, maybe. But a lot of that nowadays has been replaced by the forums and the chat rooms. And these are, you know, really vibrant places. And there's some people in there, again, making great recommendations and putting, you know, research up that backs things. But you don't know who those people are. Just take what you read there with a pinch of salt. Be wary. Imagine what it would be like if you had to explain to your wife or your husband or someone that you'd just lost 50% of the money that you'd put in because some bloke who doesn't even use his real name on the internet told you it was a great idea. Imagine relaying that story to someone and then just think carefully. And then also there's the investing industry. Again, this is another huge source of ideas at the moment, and they'll come to you through the mainstream media, through the non-mainstream media, and they'll also come to you through all the stuff that they send out nowadays, the bump that you'll get through the door, the newsletters that they'll send you, the articles that are written on their site. Again, a lot of that research is really good stuff, but, you know, these are salesmen. They're selling you something. Just bear that in mind. Whenever you're buying anything in the rest of your life, you're always thinking, well, hang on, who's trying to sell me this? Remember the same thing when you're reading investing ideas or tips. So there's another important thing to remember, I think, as well, which is our own attitude to tips and ideas. This is the bit where we tend to hear what we want to hear and what confirms what we think, and we tend to ignore the stuff that doesn't, really. So you've got those two devils, greed and fear, sitting on your shoulder. They're telling you two things. One, you're going to make loads of money. Two, you're going to miss out. Oh, don't miss out. Try not to listen to them too much. You can't always get what you want. This picture here is, that's Leonardo DiCaprio playing Jordan Belfort in The Wolf of Wall Street. I'd recommend actually reading the book, which is very good, because what he did was he ran a brokerage in the States, and essentially it was kind of, it wasn't really a boiler room, but it was that kind of ramping scenario. And the really cunning thing that they did was they rang up business owners, so they were automatically considered sophisticated investors. They couldn't be done for trying to sell stuff to non-sophisticated investors. And the business model was based on ramping shares to people who should have known much better and basically were sold a story about how they were going to make loads of money, and they piled in. Watch out for those investing fairy tales, and be very, very wary around any form of story share or story fund. It doesn't mean that it's not going to be a good investment, but just Try not to let yourself get swayed by the story and what you want to believe. So that brings me on to what I wanted to highlight as the most dangerous tip of all. This is the surefire winner. The more compelling the investing case, the more convincing it is that you just cannot possibly lose on this, the greater the risk there is of you over-investing. It doesn't mean that there's less chance of it succeeding, because actually probably the more compelling the case and the more convincing the argument, the more chance there is of it succeeding. But what there is the chance of you putting far too much money on something because you've convinced yourself that it just cannot fail. So to use the example about spreading your risk, you've got £20,000, 20 shares, £1,000 a share. This is the kind of scenario where you go to put your £1,000 on and you think, this is guaranteed to go up 30, 40%. I'm going to put £2,000 on. I'm going to put £3,000 on. And then when it goes wrong, you've lost a lot more money. Basically, you haven't managed your risk. So don't stake everything on a sure thing, because the thing about sure things is that they don't exist. Our website has up to 4.7 million users a month. I get a lot of emails, I read a lot of reader comments. Over the years that I've been working at This Is Money, we hear a lot of things that our readers say, and a lot of times that people have fallen into trouble for whatever reason, be it investing, property, any scenario where they were looking to make money. And this is very much a truism, this phrase, but if it sounds too good to be true, it probably is. That is absolutely true, that saying, and it is the thread that runs through all of those problems. So what are these pictures about? Well, I'm going to use two examples here. That's gold. That's the Brazilian World Cup. It's a Brazilian fan. Gold. In summer 2011, the gold price was hitting a record high. But there was one thing that hadn't happened. Gold miners had completely failed to keep up with this. There was a gap, and it had been identified. Now, according to those in the know, there was no way that this gap couldn't close. The gold miners were selling gold for $1,900 an ounce, but the gold miners' shares hadn't risen. That gap was going to close. There was a 30, 40%, almost guaranteed upside, probably more, because the gold price was going to keep rising. Everybody was worried about inflation. So, this was very convincing. And I'm going to bring this in here because I think one of the things I'm going to talk about in a minute is how it's important to learn about your mistakes. It was very convincing. It was so convincing that I bought into a smaller company's gold fund. I thought this was a great plan. I actually thought it was one of those scenarios where I thought, this is right, this cannot possibly fail. So what happened next? Well, 3 years down the line, the gold price is down 35%. That smaller company's gold fund, I checked the price actually the other day, that's down 80%. And even BlackRock's Gold and General Fund, which is one of the most respected of the gold mining funds, that's down 60%. So the gap didn't close. The gap actually got wider, but unfortunately the gap got wider whilst the price was going down, not going up. I foolishly held on to that smaller company's gold fund for much longer than I should have done. I should have just dumped it the moment, 15% down, put a stop loss in or something. I didn't. I sold out, I think, 2013, and I got back 40% of the money that I'd put in. And that is an example of something that there was a completely compelling case for. So why the Brazil fan? Well, here's another one, the World Cup trade. Just before the World Cup, Goldman Sachs put out their customary World Cup book. In this, they take their top analysts away from the day job of making all the money in the world, and they get them to run their eyes over the prospects of the teams in the World Cup, anything related to it, economies, stock markets, and things like that. There was a couple of things that came out of that. Firstly, Goldman Sachs's top analysts suggested that Brazil were an absolute cast iron certainty to win the World Cup. They gave them an almost 50% chance of winning, which doesn't sound like that much until you remember that that means there's a 50% chance of Brazil winning and only a 50% chance of any of the other teams in the tournament winning. They also said that England wouldn't get out of their group. They got the England bit right, at least. Although I actually looked through it the other day, and at no point did they suggest quite how awful England were going to be. Brazil, on the other hand, that cast iron certainty, well, they were humiliated 7-1 by the Germans in the semi-final on their home turf. But it's not that surefire thing that I'm talking about. The other surefire thing I'm talking about here, the World Cup trade, is that Goldman also identified this World Cup trade. And basically, their analysts had been through past history, and they said that the winner of the World Cup outperforms over the next 3 months. The loser underperforms. So there's an easy trade. And you don't even really have to take so much risk with it. You can wait to find out who wins the World Cup on the Sunday night. Monday morning, you wake up, log on to your DIY investing account, buy the winning stock market's ETF. And there you go. Over the next 3 months, it's going to outperform. The loser's going to underperform. You could try and trade that as a pair, but, you know, you're straying into dangerous territories there. So, 2 months in, what's happened so far? And to be fair to Goldman Sachs, there's another month to go. Well, Germany, the winners, their stock market is down 1%. Argentina, their stock market is up 24%. Brazil, their stock market is up 5%. So that surefire trade appears to have somehow broken down, because I'm looking at Germany down 1%, Brazil up 5%, and Argentina up 24%. And Argentina has defaulted in the meantime. So watch out for them. So if you are going to follow a tip or an investing idea, I think it's also important to work out what you'll do if it goes wrong. Because one of the first things that we always try to remind people about investing is that there's a whole host of positive reasons why you should invest. You should invest because you want your money to grow over time. You should invest because if you just leave it in cash, you're going to lose money to inflation. You should invest because it's the best way to build your wealth, and there are countless studies that will trace it back, you know, a long way and will show that. You should invest because if you're not one of those people who's lucky enough to have a final salary pension and you have a defined contribution pension, then you already are investing. Your pension is invested. That's your retirement fund. And so you might as well learn about what's going on and try and make the most of it. But you must accept money. You must accept money. Yeah, it'd be great. Here's some money, thank you. You must accept that you will lose money investing. It's a given. Not every trade that you make will work. Not every investment will turn out to be a winner. Not all tips and ideas will be winners. Do not read a magazine, the financial pages, a website, a forum, or anything else and think that every single one of those recommendations, even if they say buy next to them, are definitely going to be a winner, because they're not. So don't stake more than you can afford to lose, and that's where spreading your risk comes in. And that's where the quote from this man comes in too. That's Jesse Livermore. Now, he's a very, very famous trader, and this quote comes from a book called Reminiscences of a Stock Operator, which is a very thinly disguised biography of Jesse Livermore. And I'd recommend that anybody who invests reads it. It's actually a very entertaining read. It's a novel. It's good. And in it, he said, if I've lost money, I've gained experience. So that the money really went for a tuition fee. A man has to have experience, and he has to pay for it. Learn from the mistakes that you have paid for, and then try not to make them again. So, here's another chap that you might know, a certain Mr. Warren Buffett. Now, the reason why he's here is because it's to the bit here of the topic. What should you do with an investing idea or tip? Well, that line up there comes from one of my tutors at journalism college many, many years ago about publishing stories. And he said, check, check, and check again about 400 times a day. Unfortunately, none of us are probably ever going to be the next Warren Buffett, however well we do at investing. I hope that some of you will, and I hope I'm not puncturing any dreams here. But it's very worth listening to the man's words of wisdom. And some of those are, you don't have to swing at everything. You can wait for your pitch. What he's saying there is that patience is a virtue, especially for investors, and you don't have to take aim and fire at every single idea that comes across. It might be that the idea is great, but the price is wrong. It might be that the idea is bad. It might be that it doesn't fit into your investments. It would take you too much towards being overweight to some form of sector, some kind of company, some kind of investment. So what can you do? Well, firstly, create your own investing checklist. This is something that's going to be personal to you. Nobody can really tell you exactly what should go in there. But have a look around. There's quite a lot of recommendations around it and how you can do these things. And every time you think about buying a share or buying a fund, look at that checklist. Tick it off against it. Sit down and do that work. So what are the things that you should think about having in there? Well, I would say that you want to look at these different elements. Look at the value. Where's the value in what you're investing in? Where's the growth going to come from? Is there any momentum? Upwards momentum, hopefully. What are the dividends? How are they covered? Are they rising? Does the company have a history of raising its dividends? Has it cut them recently? These are all the elements that you need to think about when you're looking at a share. And when you're looking at a fund, this applies as well, or a trust, or an ETF. Also, ask some existential questions. What does it do? What's the margin of safety? If this goes wrong, what's protecting me? How much money am I going to lose? Also, test your conviction. So here's an idea that I think is one to consider. If you had to ditch your best share or fund in order to invest in this, would it be worth it? Now, that's not to suggest that if the answer to that question is no, you shouldn't invest in something, because there's going to be plenty of things where you would say, no, I wouldn't ditch my best share or fund for this. But it would still be worth investing in. But it does help to put things in perspective. It helps for you to think, well, hang on a minute, just how good is this? And it helps prevent what I was talking about earlier in terms of overcommitting. And I would also, again, add, do your own research. Read the company reports. Look at the numbers. Read up about stuff. Speak to people. Ask questions. I think the other thing that is important to think about is yourself. What kind of investor are you? How do you approach investing? Read as much about investing strategy as you do tips. And also, think about the mistakes that you make. Learn to counteract your temptations. The things that you do wrong, try and do something about them. So finally, it comes to this. Ultimately, be the discerning investor. This goes back to those words of wisdom at the start. Don't believe the hype. Don't swing at everything. Try to be a bit less Bruce Willis in Die Hard, running around, firing at everything and emerging disheveled, and a little bit more James Bond, knowing when to strike. Think more. Don't chase every idea and tip. Do your own research and do it properly. Be willing to take a leap of faith. That's what's needed in investing, is always that leap of faith. You've always got to go, okay, I believe in this enough to put my money in. So don't end up inert and not acting. But have an exit plan as well. Think about, where is this investment going? What am I going to get out of this? Where am I headed to? You wouldn't just get in the car to go somewhere without having looked where you were going and just randomly drive around. Think about investing the same way. So that's it, really. That's my suggestions on what to do with investing ideas and tips. I'm afraid I can't guarantee to make you all fabulously rich. I wish I could. But I can wish you the best of luck investing and say thank you very much for listening. And if you do want to come and say hello afterwards, or see us on the This Is Money stand, or just come and read This Is Money, then please do, and have a great day.